Even your most diehard silver bulls will tell you that silver usually lags gold at first and then more than catches up at the end of the bull market. So if we were in that catch-up phase, that would signal the end of the bull market. And I don't think we're there.
You're watching Silver News Daily. Subscribe for more.
The silver market is flashing red, and most investors have no idea what's coming. Lobbo Tiggre, a seasoned speculator known for spotting market reversals before they happen, has just issued a stark warning, and it's not what silver bulls want to hear. According to Lobbo, the charts are forming what he calls a hockey stick, a shape that might look bullish on the surface, but in reality has preceded some of the most violent crashes in commodity history. It's a setup that's tricked thousands before: massive vertical price action, emotional euphoria, and then complete devastation. And here's the kicker. While retail traders pile in expecting liftoff, Lobbo is quietly cashing out. He's executing what he calls the upside maximizer, a profit-locking strategy that could be the difference between survival and getting wiped out. Because what he sees next isn't just a correction, it's a collapse. And if you're all in when that happens, there may be no time to get out. So the question is, why is one of the silver market's most trusted voices heading for the exits just as the crowd is rushing in? Stay with me, because the answer could flip everything you think you know about this bull market on its head.
I remain bullish. My overall perspective is bullish gold and silver. I do not think we've reached the top for this cycle. And people are going to say the opposite in the YouTube comments, but oh well. That having been said, whenever something goes vertical, whenever something goes into hockey stick mode, it is reasonable and prudent and experience-based to at least pay attention to that and understand that that can't go vertical forever. Like no price can go in a straight line up forever. And the longer it does, the more likely the correction and the more extreme the correction is likely to be. If something is, going up at a reasonable pace, it's not so likely to come screaming down. Or there are a lot of conventional market wisdom words here, adages and things. Like, for example, the markets will take the stairs up and the elevator down, that sort of thing. That's based on real-world experience, Elijah. So I'm not saying the market is stopped. I'm saying it is reasonable and prudent to make sure that you don't let a big move up like this slip through your fingers. This is the number one message I've been really pounding the table on the last week or so. And I have gotten a lot of hate on social media. But I'm not telling anybody to sell out completely or that the market is peaked. I'm saying make sure that your big wins don't slip through your fingers. I mean, imagine you're some long-suffering gold bug who's been waiting years or decades for something like this. Do you imagine how bad it must feel to be right and then not make any money on it? That's really the point here. Is I'm not making a bear case. I am saying that nobody should lose the opportunity on the table. Nobody should be forced to suffer being right about the market and not make money off of that. So choose your own strategy. I have something you and I have discussed before called the upside maximizer. You don't have to copy me. You can do it however you want, but don't let big wins slip through your fingers because nobody knows what happens.
Every major collapse starts with the same deceptive pattern, a sudden vertical surge that convinces everyone the real breakout has finally arrived. That's the hockey stick shape Lobbo Tiggre is warning about, and it's showing up in silver right now. But what makes this so dangerous is how convincing it feels. Prices go parabolic. The media turns bullish, influencers start shouting about $100 silver, and investors pile in without hesitation. It's a psychological trap. According to Lobbo, these vertical moves aren't signs of strength. They're signs of exhaustion. They happen when fear of missing out overtakes rational analysis. The market becomes so overextended that any small trigger can send it into a violent freefall. We've seen this play out before. In 2011, silver raced from $18 to nearly $50 in under a year, only to crash back to $30 within weeks, wiping out late buyers. And just like then, we're seeing that same aggressive pattern re-emerge. A price surge with no solid base underneath it, driven by emotion rather than fundamentals. Lobbo's warning is clear. These hockey stick formations never end quietly. They end with a bang, and most people are still clapping when the floor gives out.
strategy. We used to call it the Casey free ride back in my Casey days, which is fun. That works. You can sleep well at night when you do that, and it works. But the problem is that it turns your 10 baggers into 5 baggers, or your legendary 100 bagger into a 50 bagger. I don't know why people can complain about 50 times their money, but they will if it could have been a 100 bagger, right? So without getting too far into the weeds here, it's basically like using a trailing stop, but not as a stop loss. You ratchet it higher as long as the stock keeps going up. And then when it rolls over, then that's when you take the profits. So it's not sell half on the first double. It's take some, not necessarily all, profits when the stock is no longer rising. How do you know? Nobody knows that for sure. Well, that's why you use the trailing stop mechanism, so that the math gets you out. You don't have to know where the top is. And I can tell you, Elijah, that right now I've just executed a couple of these. I had some big wins. One was up like 3.5 times. And I decided, because of the risk in the play, that I was going to take double the money I put in off the table. So what I like about this is that left me with 1.5 times the money I had to begin with. So like right now, if people are going to say, "Oh, Lobbo, you're being too cautious, the silver and gold, they're going to the moon," right? Okay. I still have 1.5 times more money in this stock now than when I started. So if gold and silver keep screaming high from here, I will make more money. But if that's not right, if it goes crashing down to, let's say it goes down $1,000 an ounce, Elijah, that's still well over $3,000. That's a great level for which the miners can make money. So it's not the end of the world. But of course, the stocks would just tank. So, if this stock goes way down, I've not just gotten my money back off the table. I have a double off the table. Like, the very worst thing that can happen to me on this upside maximizer execution is, like, the thing goes to zero and I get not a penny back for the rest of the money I left on the table. I will have a guaranteed double in my hands, including fees, by the way, no matter what happens. So, this is what Rick Wool calls the point of no concern. And, I have my own method. And by the way, the Upside Maximizer is a free report on the website. You'd have to sign up for the website. We will not spam you with a flood of advertisements, but you can see the report. It is free. You don't have to do that if you don't want. Do your own thing. I like to tell people the only way to do this wrong is not to do it at all. If you let it all ride and you wake up tomorrow and it turns out that, Mr. Market's had enough, gold went too far, too fast, and it's just correction mode, and just goes, $100 down, $100 down, that elevator down, and you didn't take any profits, you will kick yourself.
The warning signs aren't just in the shape of the chart, they're in the price action itself. After silver's explosive run to over $52 an ounce in September, the market didn't consolidate. It collapsed. From late September to late October, silver dropped nearly 12%, and that wasn't just a dip. That was a full-on rejection of the rally, a signal that momentum had flipped. Look at the technicals. The RSI plunged from an overbought 88 down to a neutral 52, while the price barely held above the 200-day moving average. That's not strength, that's survival. And here's the critical detail most people are missing. This sell-off wasn't driven by news or macro shifts. It was the market purging weak hands, flushing out late buyers who chased the vertical move. That's exactly the kind of breakdown Lobbo says we should fear the most, because it mimics what happened in every major reversal in silver's history. In 1980 and again in 2011, silver staged massive runs that looked unstoppable, right until they weren't. In both cases, the crashes that followed weren't slow. They were brutal, swift, and unforgiving. If we are indeed watching a repeat, then this recent price rejection isn't just a correction. It's the first crack in the dam.
You could put Lobbo Tiggre calls $3,000 gold. You'll get a lot of clicks. I'll get a lot of hate. But no, that's not what I'm saying. And to try to be more helpful, it's not what I think is even more likely. I think that the central bank gold buying, I think the global allocation, the political risk, the global reallocation, Rick Wool's famous 2% versus 0.5%, all these things happening right now, and not to mention inflation. The Trump agenda is highly inflationary. I know Trump fans hate it when I say that. That's not necessarily a criticism. Whether you agree or disagree with Trump's agenda, it is inflationary. Come on. I mean, Doge did not save us $2 trillion. Europe's rearmament is highly inflationary. Russia's war is highly inflationary. The only one that's really been dealing with something that at least reportedly looks like deflation is China. And ultimately, they just announced a new 5-year plan. So ultimately, the printing press always wins in the end. So all of these reasons, I think, are solid reasons to remain bullish on monetary metals in particular, but commodities as a whole. I like copper and uranium, other things too. So I'm not a bear, and I'm not telling anybody, no, I didn't say sell everything. And when I took profits on these upside maximizers, I didn't exit the positions. I just took the profits or maybe took sometimes I'll even leave the profit on the table and just recover the initial investment. So I'm risk-free. I really like it. And I'm bullish on the commodity. I'm bullish on the company, the project, the country, all these things. I'll leave most of the money on the table and only recover my initial investment so that I can't lose. It depends. One size doesn't fit all. As I say, the only way to do it wrong is not to do it at all. I'm not making a bear case. I'm simply saying, dear reader, nobody knows what the next move is going to be. And how you feel if you let some gain slip through your fingers. And by the way, if the next move is down and you took some profits, now you have cash to take advantage of that. If you're all in right now, how will you feel if there's a sale price in a month or two and you have no cash to act on it? And the answer is, well, Lobbo, what if it goes to the moon? Well, I've just answered that. I have more money now in the market than when I started. So if it goes to the moon next, that's fine. Okay, maybe my 10-bagger turns into a 7.5-bagger instead of a 5-bagger. It's still 7.5 times my money. That's a fine outcome, Elijah.
Just before we get going, we just launched the official Silver News Daily Telegram. To kick things off, we're running a 10-ounce silver giveaway. Yes, real physical silver, not a voucher, not digital credits, actual bullion. This Telegram will be our new home for real-time silver discussions, market insights, collection picks, and everything precious metals. It's where the community truly comes alive. Here's how to enter the 10-ounce silver giveaway. Be subscribed to Silver News Daily on YouTube. Turn on the notification bell. Comment 10-ounce giveaway on 3 separate videos. Be an active member of the Telegram group and say hi. Once we hit 500 active Telegram members, we'll pick one lucky winner to receive 10 ounces of silver shipped directly to you. So get in early, stay active.
And if that crack wasn't enough to raise concern, the real shift happened when the physical squeeze in London began to unwind. For months, silver's price had been supercharged by panic over tight physical supply, warehouse drawdowns, backwardation in spreads, and soaring premiums on silver bars. But that pressure has evaporated. In October, the LME spread flipped from steep backwardation to mild contango, signaling that buyers were no longer scrambling for immediate delivery. Physical premiums in London collapsed from $2.20 an ounce to just 90 cents, and 2 of the largest warehouses restocked with a combined 15 million ounces in just weeks. This isn't just noise, it's a structural change. That artificial oomph that pushed prices higher is now gone. What's left is a market trying to find real footing and struggling to do so. According to Saxo Bank's Ole Hansen, the squeeze is resolved, and silver is likely to consolidate between $44 and $50 into 2026. But here's what Lobbo is focused on. Without that physical pressure keeping the rally alive, silver is left exposed to the raw fundamentals. And right now, those fundamentals are shaky. The demand story isn't enough to carry the market solo, and with the squeeze gone, silver is already drifting lower. The excitement is fading, and with that fading excitement comes risk. Risk that this isn't a pause before another leg up, but the start of a broader collapse.
See silver as a monetary metal, and it has been tracking gold more closely this year than copper, which may sound like, well, duh, it's a monetary metal. Well, but it wasn't last year. It was tracking copper more closely than gold last year. So I'm very encouraged by this action because I'm bullish gold. And by the way, I'm bullish copper as well. So how can you be bullish gold and copper and not very bullish on silver? So it's, the very last interview I did, I think I said something similar. And like clockwork, one of the first remarks was, this man hates silver. Oh, well, what can you do? Anyway, but the reason why I'm teasing this apart is because silver did have its own unique drivers in this leg up. It wasn't just tracking gold. It started zooming higher. And my interpretation is not unique to me. A lot of people were commenting on this. We had a physical squeeze in London. And I think that's what made silver really perk up. And this is actually good news, because that physical squeeze, that, I know that there's some uber bulls that think this is it. Silver's going to the moon. The shorts are all going to be busted, and silver's going to triple digits next. Yeah, maybe. But if not, if the folks at the LME can sort out the physical supply issues now, and there is data that suggests they are as we speak, then I think silver, it doesn't necessarily go down or go into a bear market. I'm not saying that. I'm saying that the extra oomph that it got from the short squeeze goes away, and then silver goes back to trend. And for all the people who says, oh, he hates silver, not at all. I think this is very good for both gold and silver, because if silver really was finally catching up to gold, even your most diehard silver bulls will tell you that silver usually lags gold at first and then more than catches up at the end of the bull market. So if we were in that catch-up phase, that would signal the end of the bull market. And I don't think we're there. I'm a fundamentalist. I don't think we're there for all those reasons we articulated earlier. I don't want it to be there either. I want it to go higher. Mr. Market doesn't care what I want. But I neither want nor think that we're at the end of the market. So silver catching up to gold was a concern to me. Silver catching up because of the physical squeeze in London that did not apply to gold is a huge sigh of relief for me. And, we'll see where it goes next. This does mean I think that there's potentially more volatility to the downside in silver in the near term than in gold. But, that's not a surprise to anybody in silver and gold. We all know that silver is more volatile than gold. I'm just saying beware of an extra spicy near term for silver. And if you're a bull, hey, that means more buying opportunities. And by the way, if you exercise some upside maximizers or whatever strategy you used, if you locked in some gains and now you've got extra cash in your trading account and we do get a sale price, well, that's a good thing. If you're an uber bull, the worst thing in the world is to have an obvious buying opportunity and no cash to act on it. I remember this in 2008. In late 2008, like particularly November, December, I had a lot of readers, they were long-term bulls. They got it. They understood that gold correcting down to almost 700, that was an opportunity. But the agony that I could hear in their voices, reading between the lines in the email, the agony was they see it, they understand it, but they were all in. They had no cash to act on it. So this is another reason why one should not let profit slip through your fingers. That doesn't mean you're a bear. It means, A, you don't want to lose money. Rule number one, don't lose money. And two, it means that you're providing.
But the most telling sign of all is how silver is moving relative to gold, because it's not keeping up, and that divergence is dangerous. Throughout 2025, gold has surged nearly 38%, while silver, despite all the hype, is up just 28%. That's a major underperformance, especially in a bull market where silver is supposed to act like gold's high volatility cousin. What's more alarming is the gold to silver ratio. It widened from 82:1 to 88:1 between mid and late 2025, confirming that silver is not leading this market. It's lagging. In real bull runs, silver eventually explodes past gold, signaling the top of the cycle. But we're nowhere near that. In fact, this kind of lag usually appears at the beginning of a bull market, not the middle. Lobbo sees this widening spread as a key indicator that the silver narrative is getting ahead of itself. The divergence suggests that gold is absorbing the monetary demand while silver is losing momentum. That's not bullish. It's a sign that the silver hype train might be running on fumes. And for investors who are betting on silver to catch up, they could be waiting a lot longer than they think. Because if silver isn't playing its usual role in this cycle, then the rally we just saw might not be a launching pad. It might be the blow-off.
Is actually the fundamentals. I am a fundamentalist at the end of the day. That's how I make my investment decisions. To the degree that I look at technicals, it's more like where are my entry and exit points? Like how tactically I execute on my fundamental strategy is where the charts come in. But but to your point, the reason for this is some of the pushback that I've gotten when we were before this week's correction. When we're still in this hockey stick mode, a lot of the pushback I was getting for saying, hey, folks, whenever you got a hockey stick, nobody goes broke taking profits. Oh, and by the way, I said the same thing in early 24 when uranium went triple digits. And I got so much hate for anything other than uranium's going straight to the moon. And look at history. like look at what happened. So, I was saying something similar about gold. I was not calling it top. I was just saying, hey, some correction here is not unexpected. And then I had chartists responding. But look, in 1979, when gold was screaming up towards, $850 an ounce, look at that chart. There's no correction in there. It's just a smooth parabola upwards. Okay, let's accept that. Let's stipulate that as, what happens as you go into the blow off top. As we were just saying before, I don't want this to be the blow off top. Mr. Market doesn't care whether I want it or not, but based on the fundamentals, I don't think we're there yet. So if we weren't there yet, looking for some correction, an interruption in that parabola made sense to me, right? That's not a bear case. It's just saying that, it's not an end market case, all right? And so I think this break is actually, people hate hearing about a healthy correction. But in the context of my longer term bull case, I actually do think this break is a healthy correction. Because if it just continues screaming upwards, well, Elijah, we would be looking at a blow off top. And, okay, I'm long. Our audience is probably long. We could make a lot of money in the near term in this blow off top if that's what was next. But that would be it. That would, the most likely thing after this vertical move would then be a bear market for years, like a screaming back down in the elevator and then a bear market for years. Who wants that? Now, again, Mr. Market doesn't care what we want, but I'm just saying, be careful what you wish for. Nobody goes broke taking profits. It doesn't mean you're a bear, and it does load you for bear. Like, if we get a correction, you'll have funds to do something about it with. And so, yes, I think this kerfuffle we've had over the last week is very encouraging to me. It tells me that we're probably not at the blow-off peak yet, and that is a good thing.
Dig deeper, and the institutional data tells an even more sobering story. Behind the scenes, the big players are repositioning, and not in a way that supports the idea of a continued rally. In October, COMEX data showed managed money net longs dropped 28% in just 2 weeks, with 42,000 contracts liquidated. Open interest fell 11%, and daily trading volume spiked to 180,000 contracts on October 21st, 3 times the average. That's not bullish behavior. That's exit liquidity. Even more telling, JP Morgan slashed its short position by 12,000 contracts in Q3, while Goldman Sachs added 8,000 longs. 2 opposing moves that scream repositioning, not conviction. These aren't signs of a coordinated short squeeze brewing. They're signals of reduced leverage, de-risking, and cautious sentiment. According to TD Securities, this is healthy deleveraging, not the beginning of a short covering rally. And that fits Lobbo's thesis perfectly. The volatility we're seeing isn't coming from forced buying, it's coming from speculative liquidation. When the biggest market makers start adjusting their exposure mid-rally, it's not because they believe the next leg is higher. It's because they're preparing for what happens if it isn't. And that preparation could be the clearest warning yet that the smart money sees a reversal coming. Even the industrial demand narrative, often seen as silver's saving grace, isn't strong enough to offset the growing downside risk. Yes, demand from solar, EVs, and AI infrastructure is hitting record highs. Solar panel production alone is projected to consume 232 million ounces of silver in 2025, up 14% year over year. EV battery demand is set to rise 11% to 88 million ounces. And AI data centers? Their electrical infrastructure is now responsible for a 22% increase in silver loading. These are big numbers, no doubt. But here's the problem. They're not stopping the price from falling. Why? Because in the short term, industrial demand is structural. It doesn't chase price. It supports the floor, not the ceiling. And Lobbo knows that floors don't protect you when the ceiling collapses. On top of that, recycling and mine output are creeping up just enough to keep the market in deficit but not in panic. Mine production is flat, recycling is up 2%, and overall supply is still short of demand by over 160 million ounces. That sounds bullish, until you realize that despite this ongoing deficit, silver still broke down after a parabolic move. That tells you everything. The price isn't responding to the supply-demand imbalance anymore. It's reacting to momentum, emotion, and fear. And when those take over, fundamentals take a back seat.
Express anger at me. Oh, Lobo, if I had listened to you, I wouldn't have made any money on platinums here. Platinum's up more than gold. Yep, that is true. You can't kiss all the girls, and you only get black guys if you try. No, so I didn't make any money on platinum this year. Well, not really. I'm not going to quibble on that one. Let's just stipulate I didn't make any money on platinum this year. That's true. I did make money on other things. I'm not going to worry about the opportunity that I missed as long as I'm making money. I'm okay with that. But look at what happened here. It's not like platinum and palladium and gold and silver all marched in lockstep up into this thing. The industrial metals lagged significantly, not just silver. Silver actually responded earlier, but platinum and palladium catching up more now is a very recent thing. So this is not the same market that we've seen all year long in gold. And my interpretation of this, it's not that suddenly, well, actually, as you and I record, there's reports of a physical shortage in London on platinum too. So maybe there'll be a short-term squeeze here as well. But I don't think this is driven by suddenly there's this huge increase in automotive demand for platinum and palladium and not enough mine supply. And so the whole industry is now fundamentally on a more sound basis. That's not what I think is happening. If anything, I think the signs of economic weakness, which most hard metals advocates, hard money advocates would agree with me that there are signs of economic weakness out there. That's bearish for these metals, these PGMs that are, no matter how precious they may be, their use case is industrial mostly. There is some platinum jewelry, but not a lot. So what I think is happening, it's not that, the fundamentals improved here. I think that what happened is gold's screaming up, silver's catching up, we're hitting all-time highs, and people are jumping on board and saying, oh, yeah, I love it. I believe in this thesis. It's going up. But it's hard for me to pay an all-time high. Well, what's like this and still on sale? Well, hey, look, platinum's still cheaper than gold. Palladium is way below its recent highs. So I think that's really, I can't prove this, but for whatever it's worth, my old wolf whiskers, my sense of this market is that this was a Johnny-come-lately reaction to, gee, I really like the precious metals story, but I don't want to chase all-time highs, so I'm going to buy the relative bargains. And, that's fine. That can work. No telling how long that will last. And I haven't looked at the market action this week, but last week when gold corrected, gold and silver corrected, platinum and palladium fell sharply as well. Like, the magnitude on the way down was like the magnitude on the way up. So if you're a platinum bull, you better have, guts of steel to ride out the volatility, and, beware that, the Johnny-come-latelys, that these are not the diamond hands in metals and mining. So any panic that hits gold and silver is going to whack your platinum and palladium harder, I think, if I'm right about what's going on here. And they're both highly vulnerable regardless to further Trump shock or scary economic news out of Europe or China. So, buyer beware. This is not a bear case. This is a caution. And personally,
but the most dangerous trap isn't in the data, it's in the mindset, the gold bug mentality, the belief that silver can't crash because it's too undervalued, or that every dip is a buying opportunity on the road to triple-digit prices. Lobbo Tigering is sounding the alarm precisely because this kind of thinking is what wipes investors out. Right now, too many people are anchored to narratives that no longer match the reality of the market. They're clinging to hopes of a mythical short squeeze, or telling themselves silver has to explode because gold is moving. But here's the truth. The short squeeze already happened and fizzled. Physical premiums have collapsed, arbitrage opportunities have closed, and COMEX inventories remain stable. The so-called squeeze isn't building, it's been diffused. And as for gold dragging silver up with it, that's not what the ratio says. In fact, silver is diverging. But the most dangerous part is that belief that doing nothing is the smartest move, that holding through a crash is noble or wise. Lobbo's warning cuts through all of that. He's not telling investors to panic. He's telling them to wake up, to recognize when the narrative has shifted and to act before the floor disappears. Because in a falling market, hope isn't a strategy. It's a trap. While most investors are busy doubling down, Lobbo Tiggre is executing a completely different playbook, one built not on faith, but on calculated timing. He calls it the upside maximizer, and it's not about catching every dollar on the way up. It's about locking in profits before gravity takes over. Lobbo isn't selling everything and disappearing. He's scaling out, selectively trimming exposure while others are still celebrating last month's highs. And here's why that matters. He's preserving cash and optionality, because if silver does crash like he expects, he'll be ready to buy again, at deeply discounted levels. It's not fear, it's discipline. Lobbo understands that volatility is where the real money is made, but only for those who survive the drop. He's not chasing headlines, and he's not interested in riding silver all the way down just to prove he's a true believer. He's managing risk and positioning himself to strike when the market resets. That's the essence of the upside maximizer. It's the strategy that sidesteps the emotional roller coaster and focuses on opportunity, not ideology. And while it might not sound exciting to take profits in a bull market, Lobbo knows that sometimes the best trades are the ones you make before anyone else sees the cliff edge coming.
Yeah, I've gotten hate for being so bullish on copper this year, but copper did hit an all-time high as well, at least nominally. But I must be honest and say not for the reasons I thought. And I've not moved in a big way into copper yet. I did find some opportunity that I thought was too good to pass up. But I'm still waiting. I still think that for the same reasons I'm cautious about platinum and palladium industrial metals, that's a reason to be cautious about copper. I think we've talked about it before, so we don't need to go into great length, but the bull case for copper, I think, is extremely durable. I think it lasts years, if not decades. It's Dr. Copper for a reason, an essential, critical mineral that does not need AI or electric cars to send it higher, but those things are obviously tailwinds. So extremely bullish. You could make a similar case for uranium. They're different, but you could call them both energy metals. So you could look at them as similar, but the greater similarity is less so much in the end use than in the structural issues of supply constraints. And there was a concern about uranium that high prices would cure high prices. And there was a lot of mothballed production that could come online. There was voluntary supply constraint, like with OPEC. And so I think it was reasonable for people to be concerned about uranium pulling back. But what we've seen since then is that basically none of the low-hanging fruit turned out to be easy to pick. The two biggest and best producers in the space have moved the goalpost back. You know who I'm talking about, dear uranium bulls, right? Both of them have moved the goalpost, and pretty much everybody else is either late, off track, has cut their ramp up guidance, or has just flat out failed. They're not going forward. So I like them both. Both are supply constraint. Uranium is more recession resistant than copper, so that has me sort of near term more bullish on uranium. If I had an opportunity, an equal looking opportunity in uranium or copper this week, I'd buy the uranium one, not the copper one. If I could choose only one, I'd go with the uranium one because uranium is more recession resistant than copper. On the other paw, there's no copper reactor meltdown that can take the whole market south, overnight. Whereas that is a possibility in uranium. I think it's unlikely. I don't lose sleep over it. I'm not worried about it. I invest anyway, but I always remind people that you should only invest in uranium, understanding and accepting that there is a tail risk that can have you literally wake up in the morning and suffer a major loss of capital. And that is not a risk in the copper space. So I like them both, but they have different risks and rewards. and I'm actively seeking to add exposure to both in my portfolio. Uranium now when I find an opportunity, copper probably on the next dip. If I don't get a dip, then I just buy anyway.
Well, Lobbo Tiggre, thank you so much for joining us today, especially.
If Lobbo Tigering is right, the silver market isn't just due for a correction. It's on the verge of a controlled demolition. What looks like a healthy pullback to some may be the start of a deeper, sharper collapse that rewrites the silver bull case in real time. This isn't about being bearish for the sake of it. It's about recognizing that even the strongest assets can fall hard when sentiment, structure, and momentum all turn at once. And right now, all three are flashing red. But here's the twist. This collapse isn't the end. For disciplined investors, it's the setup. The flush that clears out the noise, resets the market, and opens the door to re-enter at levels others won't believe are possible. Lobbo's warning isn't a call to run, it's a call to think, to reassess, to strategize, and to be ready when the dust settles. Because the next true rally won't be driven by emotion or euphoria, it'll be built on patience and precision. If you want to stay ahead of that moment, make sure to subscribe so you never miss what's coming next. And remember, this is not financial advice. Always consult a licensed financial professional before making investment decisions.